properties. Don't let that reason to not buy properties be fear. Be fear of the market, be fear of the uncontrollables. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer, and excited for another episode. Been thinking a lot about last week's episode, and I talked about just traps and things to watch out for when you're looking for passive investment, when you're looking to do a passive investment, maybe set one up for your investors, things to really be thinking about. So if you didn't listen to that, go back and listen to that. But along with that, I have seen several posts on LinkedIn, and it's been making me think a lot about what other people are doing to get deals and what we're doing to get deals. And we're always saying, why aren't we getting as many properties as we want? And right now we're getting nothing, quite frankly. So it's frustrating because we aren't landing any deals, and we're trying. It's not for a lack of trying that we aren't landing deals, excuse me, but it is because of something, right? And so what is that something? Is it something we can change without, we want to make sure we're careful and we don't completely change our underwriting, we don't want to change our investing philosophy and get ourselves into trouble, right? That's really easy to do. You get anxious, you say, man, I want to get a deal. I need to get a deal. We haven't done a deal in a long time. I came from the flipping world. I was used to doing, 50 deals a year. And then I go to the apartment world and I'm all of a sudden doing, 3, 4, 5 deals a year. And now, it's been an entire year since I've closed on a property, entire year. And I haven't closed on anything. And so it's frustrating, but at the same time, we are putting our head down. So we're looking at what we're doing. Are we doing anything wrong? First of all, because when you don't get deals, you go, okay, what do we need to adjust, if anything? Do we need to? Are we doing something wrong? Are we not looking at enough deals? Are we not talking to enough brokers? Are we not getting cracks at some of the maybe off-market deals? Do we need to direct to owner market? What do we need to do differently in order to get access to deals? Because deals are still getting done. But are those deals just crappy deals that we just never would have bought in the first place? Like, what is happening? Why are we not getting properties, but other people are? And so we got to look at those things. You got to determine, okay, are we doing something wrong? Is the market doing something wrong? Are other people doing things differently? And I think it's a combination of a lot of things, right? So first of all, I'm not going to sit here and say we're doing everything perfect with our underwriting. We're always looking at ways to tweak and maybe expanding our criteria a little bit. Does that make sense? Do we look at different locations? Do we are we talking to every single broker? Are we getting access to these deals, right? Again, do we direct market? And so we're always looking at that and trying to make little tweaks. But again, we want to stay true to our belief system with our underwriting, where things go, because we don't want to get a deal under contract and it not work. Things go wrong enough in real estate and in business that we don't want to do something that really hurts us, and sets us up in a improper way. So first thing I'll say is a lot of people, in my opinion, in this market are just doing deals they shouldn't do. And I think that there's going to be people, even today, we say real estate values have gone down 20, 30%, really 15 to about 30%, depending on your market. I still think to this day, people are overpaying for properties. And again, that's not everybody, and everybody's got different criteria. So I don't want to stick with me here. But I do think that there's plenty of people that are overpaying. And so I think that's one thing. They're desperate to get deals. They feel like they have to grow the company. They're using those fees to keep the doors open. They're using those fees to potentially pay for deals that are struggling, that they put under contract and purchased back in 2021, 2022. And now those deals need rate caps. Now those deals need capital infusions. And instead of, going and asking for capital calls or letting those deals go bad, they are forcing themselves to go buy new bad deals in order to pay for the old bad deals, and that's a slippery slope. That's a big spiral. But I do believe there's companies doing that right now as well. I don't know, just theory. Okay, but here's what I'm going to say: is everybody's got a different criteria and a reason to invest. And so I saw a post on LinkedIn. It was about a company, and they have purchased in the Twin Cities a lot of really nice product in very nice areas. Okay, so we're talking high-rise buildings, gorgeous locations, uh, traditionally very, very excellent locations, newer built buildings, nicely renovated, or newer built. And their investment philosophy is they're betting on the city of Minneapolis that it will come back. Okay. So they're getting these properties for less than what they were built for, or less than what they would have sold for just a few years ago, quite a bit less. They aren't necessarily cash flowing really well today. They bought them for probably too much if you look at today's market, but they're okay with that because they firmly believe that the market will play out well into their favor. They firmly believe that today rents in the downtown Minneapolis, or the areas that they're buying in, are pressed down more than what they should be, and that they will come up, and that the vacancies will subside, and they will be left with very well performing buildings. And so they're saying, hey, we're just going to cash flow poorly right now for a few years, but we've got these well located, really strong assets, and just phenomenal buildings that when the market bears out, we're going to be sitting here looking really good. Our cash flow, yes, is low. Our IRR, if we're looking at a sale today, is really not that good. But if things happen the way they think they will happen, they'll do well on those investments. They probably will. Now, in my eyes, it just doesn't work. I couldn't send these deals to my investors and say, hey, look at these deals. They're exciting. You're getting, 2% on your money for the next 5 years, 2% cash on cash return for the next 5 years. And guess what? Today the market's at a 6 cap, and we're going to underwrite, selling at a 4.5 cap. Like, that just doesn't work. Right. But they are putting the bet on that's what it will be. And so they can say, hey, this is great. This is exactly what we want. And they have different money. It's either their own cash, they have very patient investors, whatever it might be, but they have different money that is willing to place the bet on them, and what they're willing to do. Again, it could be their own cash, it could be somebody else's cash, but it's just different money than our money. They also wouldn't do probably most of my deals. Okay, because they like these clean class A plus, we have to do nothing to it. We're just betting on market appreciation. Where my deals, you have to value add, right? There's work to do. They're not in A plus class locations. They're not A plus class buildings. And so the deals that I do, they're like, oh, those are crazy deals. We wouldn't want to do those. Right. So it's, again, different strategy. I was looking at a group that purchased some buildings we underwrote recently, and I did scratch my head on this. And it's not to say, again, not to say they're doing something wrong, because I didn't talk to the sponsors, but I was off by about 30%, or we were off by about 30% from their purchase price, and just hitting really basic returns for investors, quite frankly. Nothing exciting, nothing to write home about. I mean, a good cash flow, we're hitting, 6 to 8%, 9% cash on cash returns, and then just a simple 14% IRR. That's it. This group overpaid by 30%, in our opinion, way above what we would have came in at. They're a syndication group, much like us. So I'm like, well, how can they do that? Well, first of all, they posted that it was a gorgeous location, growing submarket, blah, blah, blah. It was beautiful. Well, it's a C-class location. I wouldn't call that a gorgeous location. It's not a growing submarket. It's, quite frankly, just stagnant, if not shrinking. A lot of crime going on there. Beautiful building, by the way. A lot of great renovations, just gorgeous building, amazing amenities, the whole works. So you could place a bet on that, but it is an older building. It was renovated. So is it really an A class? No, it's, it's a C class building that has A class renovations to it. Um, so what did they see? They maybe they did think that this was an A class location. They got fooled. I'm not sure. And so could they be underwriting exit caps as if they bought in an A class area? So, they maybe bought this for a great cap rate based on an A class area, not a great cap rate based on a C class area. But if they think it was an A class, they bought it at a really, really excellent cap rate. And so when they go to sell it, they're underwriting an exit at a, maybe call it a 5 cap. I recently saw another person posting on LinkedIn that they're actually doing cap rate compression. So when they go to exit a deal in 5 years, even though today's cap rate may be at a 6 cap, okay, they're saying, hey, in 5 years, it's going to sell for a 5.5 cap. They're putting a bet on the market that says people are willing to pay more money 5 years from now on a ratio basis based on the income than they are today. What would that take? Probably interest rates going down, really robust economy, low vacancies, exuberance in the multifamily market. Is that possible? Absolutely. But you're betting on that happening. If it doesn't happen, you're kind of screwed, right? Your investors are really screwed if that doesn't happen. So, anyways, so they could be doing the same thing. They could be just projecting that it's A class area, even though it's C class. Not sure about that. They also might just have more patient money, right? They have money that's maybe looking for some mailbox money. They just want simple, low dividend. They're okay with 2%. They're betting again on the market just being improved. They're betting to say, hey, look, prices have declined by 20% and they're going to rebound. And so in the future, we're going to sell this for way more because prices will rebound back to where it should be. And so they have investors that are like, yeah, wow, we'll put a bet on that one, right? We're willing to do that. Or maybe they have 1031 exchange money where the 1031 person's like, hey, look at that. I don't really care. I'm going to have to pay a boatload of taxes and depreciation recapture unless you find me a building. They say, hey, we got one, right? We got a building for you, place in this. Returns aren't great, but great place to park your money. You're not going to lose. Oh, great. Let's do that, right? So they might have that 1031 money as well. So there's different reasons possibly that they bought that. Or again, they're just desperate. They need to get a deal done. They're being over exuberant and irresponsible. And they came into the market and they just overpaid. That could be could be a conclusion that they shouldn't have bought the building. Interesting to hear from brokers that most of the people that are buying right now are not syndicators. Very few people. In fact, almost all syndicators that I personally know are not buying right now. Not that they're not wanting to. Again, we're wanting to. We're underwriting deals, but they got the same thing going on. They are underwriting deals. They want to buy the right deals, but nothing pencils out for them. There are syndicators buying. I personally don't have relationships really with those syndicators, so I'm not sure exactly how they're finding their deals or what they're buying or what they look like. But most of the people I know that are syndicators aren't buying, and that jives well with what the real estate brokers are telling us too, is that that's not our competition right now. It was our competition a year and a half, 2 years ago. It's not right now. Okay, so let's talk about why people are buying today. And I've already hit on a lot of this stuff. So there's several different types of buyers in the market. You've got a buy and hold buyer versus a flip buyer. Those are two totally different looks at the market and what we're looking for. So buy and hold, straight cash on cash. So a great buy today for a buy and hold is somebody who's can assume a mortgage, right? It's got 5 to 7, maybe even longer, a HUD loan, something like that. It's got great interest rates. We can assume it, and we just milk that cash on cash return out. We can get 7 to 10% cash on cash return, milk it out. We maybe have overpaid a little bit for the property, but that's okay because, man, interest rates are great. It's locked in for a long time. And we're just going to milk that thing out and hold the cash flow versus the flip who needs that. They don't need the cash flow. Quite frankly, they don't need a cash flow at all. So they're probably not caring about an assumable mortgage. They want something that might be a little bit more distressed, or they're buying basis place where they're saying, hey, this thing's got a ton of equity in it, or we can create a ton of equity. That's what we're going to do. So those are two different buyers. And along with that, buying holes, that mailbox money, right? They just want to get in that mailbox and make sure they got those dividends. You also have large, kind of more corporate versus mid-size. And large corporate, think of the REITs, they have a totally different look. Investor base is totally different. They have a different makeup of a company, a ton of stuff in house, so they can be very efficient at times. And quite frankly, like, look, they just sometimes just place bets on the market. Blackstone just came out; they're buying a bunch of real estate, and they just feel like real estate values are going to go back up, and that we're somewhere closer to the bottom than we are to the top. And so they're saying, hey, we're just going to buy. And yeah, maybe the deals don't make a ton of sense right now, but they're placing a bet on what's going on in the market. They're just buying. They're just aggressive. They're happy to quote unquote overpay because they think they're underpaying in the future, right? And so they're ready to buy. And by the way, the returns that their investors get or expect are much less than the syndicators. So, if they can pay their investors 6% cash on cash dividends or cash on cash, like that's totally fine. And they don't need to even pay that much, right? So they're hoping for their stock to appreciate and value, and they're good to go, right? They are hungry for moving their money because that's how they get paid, is circulating a lot of money. So they're needing to do deals. Where the mid-size or the smaller investors can be more patient, and have to be more patient when the deals aren't penciling out. And private equity, family offices can play into kind of either side, quite frankly, their returns, but their returns tend to mirror kind of a syndicator's return. So they're often, again, trying to be more patient, a little later to dip into the market. They're not as early as a player as like a REIT might be, but they're not. The REITs were out of the market earlier too. They got beat up pretty quick early on, and now they're back into the market. 100% cash is another buyer, and so they don't care about what's going on with the interest rates. And so these deals right now today look pretty good to them, right? They don't care about interest rates. They're used to lower kind of cash on cash returns, IRRs. That's not what drives them. What drives them is no risk and good, steady returns. So look, if they bought a property in 2022 and took that same property and bought it today, they're getting a 30% discount or 20% discount. That looks really good to a cash buyer. And so they're excited to go into the market and buy. We competed at a property lately, and there was an all cash buyer. This is a $22 million purchase, all cash buyer that was in. They're ready to go. Their money makes a lot of sense right now with these high interest rates. You've also got a 1031 buyer who sold something and they just need to place it. They're going to be super competitive. They're always competitive. They're always going to win the deals and be willing to overpay because they don't want to pay a ton in taxes and depreciation recapture. Bridge versus agency versus CMBS. Look, some people swear off bridge. They say they will never touch bridge, never touch it again. I'm torn a little bit on that. Does it make sense to get into a bridge loan today? Maybe. You can definitely make the argument of it, but a bridge loan or a construction loan with a local bank, those are high risk, high reward type loans. If interest rates play into your favor, they work out really well. if you can execute your business plan and the market behaves, they play out really well. Where you get caught in bridge loans is if interest rates go up, especially substantially like they did in 2022 and 2023, that they catch people really quickly. And if the market shifts quickly, again, they catch you quickly. So, look, if you are a firm believer that we're at the bottom of the market, that interest rates are at their highest level they're going to get to, or really, really close at least, bridge loans probably a fairly safe play. Okay. Um, but if you're in the belief that interest rates could go up and the market could go down, bridge is a big risk. And so bridge is always your biggest risk loan. And are you willing to play that game? And if you are, you can make a lot of deals work that the rest of the market maybe can't make work. So I'm not telling you one way or the other. It's just the nature of the beast. Bridge loan, if you're going to go with it, it's going to be higher risk to lose investors' capital. And if the market behaves, you'll do well. If the market doesn't behave, you won't do well. And those are things that are out of your control. You can't control where interest rates go. You can't control where investor appetite is. You just can't control those things. Agency debt, you can lock those in for longer term, or you can do floating as well. But you can lock those in, and those are going to be safe, at least much safer. But again, likely your returns are going to be lower if you do that agency debt. CMBS, same type of thing as the agency, a little bit more risk. And then HUD is your super safe. Lock that in for 35 years. You don't have to worry about it. Interest rates don't go up or down. You're just, boom, you're locked, loaded, ready to roll. Hold that property for long term. HUD loans are great for long term buyers. If you're going to keep that property for 10 plus years, they make a ton of sense. If you're going to buy and sell and flip these properties, HUD loan doesn't make any sense unless you can assume it, but still really hard to make sense. And then I already talked about that cap rate at the sale. It's really easy to start making deals work if you're going to get aggressive with those cap rates. If you're going to say, hey, today's market's a 6, or we're going to sell it for a 5 just because we feel like we're at the top of the market, it's really easy to start penciling deals out. We could have probably bought several deals this year instead of 0. We probably could have bought 5, 6, 10 deals if we would have been aggressive with our cap rate at sale, like some people maybe are doing. All right, so lots of different reasons to buy properties, lots of different reasons not to buy properties. Don't let that reason to not buy properties be fear. Be fear of the market, be fear of the uncontrollables. That's something that I'm trying to really make sure we're not doing. We're not living in fear, and we're still being aggressive, but sticking true to what we believe is a good investment strategy. So that's the key. Is I don't want to live in fear. I don't want to say, hey, we got to be super careful. We can't buy that deal because X, Y, and Z, and be coming up with every single excuse to make sure we're not doing that. But I also don't want to be overly aggressive to where we do get caught if any little thing goes wrong in the market. So that's it. That's all I got for today. Go out there, look, get deals done, get them done, work them, get aggressive with the brokers, get aggressive. Make sure you're keeping those relationships going. Make sure you're underwriting all their deals. Make sure you're communicating when deals work and don't work. Make sure you're doing the little things to keep those relationships growing, even if it's a frustrating time and you're like me, where you're just not finding deals. And then, get creative, figure out different ways that you can get deals in front of your desk so you can underwrite more deals and be out there and be productive. So that's it. I'm signing out. Make every day a Saturday. Hey, thanks so much for listening. I appreciate you being a loyal listener. Say, I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.